Over the last couple of weeks, many of us have been taking stock of the first half of the year. For instance, the NSE gained 25%, but fixed deposits and treasury bills fell, leading us to ask, did we earn enough? Did we spend in an optimal manner? Did we save enough? How did our investments perform? These questions can give us sleepless nights. Mint is your essential guide to navigating these turbulent waters. We simplify the complex issues so you can apply practical solutions on how to earn, spend, save, and invest. Join us as we turn uncertainty into clarity. This is Mint. My name is Lydia Nyawira.
Earn it, spend it, save, invest. Earn it, spend it, save, invest. Mola, kila siku niko chesa mola, make more bila stress. Mola, kila siku waste mola, make more bila stress.
Today on Mint, unit trusts, where the money goes. On Money Moves, we find out how unit trusts generate income. How to build an emergency fund. How easy is it to start an emergency fund? Find out more on Mula Hacks. Jobs of the future. Which skills will earn you more in the next 5 years?
Earn it, spend it, save, invest.
Last week, we broke down what unit trusts are. In today's Money Moves segment, we look at what happens behind the scenes after you put your money in a unit trust. What next? Who decides what to invest in? What are the risks? How will your money generate an income? We'll answer all these questions and more in this episode of our unit trust series titled Where the Money Goes.
Now that we understand what a unit trust is and the types of trusts that one can invest in, one will be curious to find out how the money will make a good return. When putting money into an investment scheme, the most common question for any investor is, where does the money go and how will it generate a positive return?
So when you deposit in any unit trust, or rather if you invest in any unit trust, the money first goes to the custodian. So the custodian, this is the person who holds your money, awaiting instruction from the fund manager or the asset manager on where to invest.
A custodian is a company, usually a bank, approved by the Capital Markets Authority to safeguard the unit trust's funds. After the money goes to the custodian, the next destination for your money will depend on the type of unit trusts you choose to invest in. For example, treasury bills, fixed deposits, shares, among others.
In the case for money market, this is treasury bills and fixed deposits. So when we as the fund manager or a fund manager invest in the treasury bills, they earn an interest. Once the interest is paid to us, we distribute to the clients on a monthly basis.
Treasury bills are a secure, short-term investment that fund managers invest your money in, and depending on the treasury bill issued by the government, it can mature by either 91, 182, or 364 days. The interest rate the money market fund earns will therefore depend on the treasury bill interest rates. For fixed deposits, the fund manager puts a lump sum of money in a bank account for a certain period of time at a specified interest rate.
So we approach a bank and tell them we have X amount of money and would want to fix a deposit with you. Say 3 months, 6 months, 12 months. Which rate are you going to give us at the end of the period? They would come and tell us 10%, 12%. And from that, after the maturity of the fixed deposit, they give us the interest plus the principal, which we distribute to clients.
For equity fund, the money invested in shares can earn via dividends or capital gains.
It's at the discretion of the fund manager to pick the shares which offer the best returns based on the fund manager's research. So dividends, you've given us the money, or rather you've invested in the equity fund. You bought shares, say your Safaricom, your NCB on the Nairobi Securities Exchange. These companies pay out a dividend. Most companies pay out semi-annually, twice in a year. So once they pay out the dividends, they pay the dividends to the fund manager, which we in turn pay out to our clients. So that's one way. I'd also mentioned that for equity fund, it has a daily price. If it was at 100 shillings, you bought it today at 100 shillings, tomorrow it's trading at 1 or 2. Dependent on the price that it will be at that time, you will have made that difference of the price you bought it at and the price you sold it at.
Next, your money will go to a fixed income fund or bond fund, where fund managers invest in corporate and government bonds in the secondary market of the Nairobi Securities Exchange. A corporate bond is a type of debt security issued by a corporation and sold to investors, and the maturity period for this type of bond can be short-term, which is less than 3 years, medium-term, which is 4 to 10 years, or long-term, which is more than 10 years. On the other hand, treasury bonds are units of government debt that offer investors interest payments every 6 months throughout the bond's maturity. They are offered for a set number of years, ranging from 1 to 30.
Going on to the bond fund, you also earn monies twofold. This is you earn one via an interest, because bonds usually pay out interest semi-annually. Once they pay the fund manager the interest for that period, say for that half year, you distribute it to the clients. And also you find that for the bond fund, it also has a daily unit price. Upon selling the unit of the bond fund, you can make a profit based on that difference of price.
Finally, your money will go to a balanced fund, which is a combination of 2 asset classes. A fund manager can invest in either bonds and shares, while in another, they can invest in treasury bills and shares.
Going on to the balance fund, it's the best of both worlds. It gives you an interest payment on one end. On this other end, it also gives you the scope for capital gains, because when we say capital gains, the share values fluctuate quite a lot. In a short period of time, you find that even within a week, you might find a share might have appreciated by more than 5 shillings. And this gives you a good room for capital gains, in the sense that if at the beginning of the week the share was at 50 shillings, at the end of the week it's at 55, it's very easy to realize that difference in the form of capital gains.
To realize the highest gains, most fund managers have a research team. The team analyzes the market conditions before investing in any asset to ensure that it is the right time to buy.
They do this to advise the portfolio managers on the best course of action, to ensure that the fund value, when I say fund value, this would be the fund value of the bond fund, the money market fund, the equity fund, to make sure that the fund value is growing. So yes, we do monitor, and we have a dedicated team that actually looks into that to be able to inform the decisions of the portfolio managers.
Now that we know where your money goes, in the next video, we will find out what can affect your earnings depending on the unit trust you invest in.
Earn it, spend it, save, invest.
On Mula Hacks, we examine how emergency funds can come through for us when we need to cover urgent medical bills or everyday expenses after losing a job. Emergency funds can help us avoid taking on unexpected debt or financing unforeseen costs.
In Kenya, life can change in a moment. A job loss, a hospital bill, a car breaking down in the middle of the road. But what if money wasn't the first problem to solve? What if it was already part of the solution?
First of all, we need to define what an emergency is. So in the world of finance, it's something that comes up and it has financial obligations.
This could range from your car breaking down, a loved one falling sick and you don't have insurance, the rent is due and your paycheck hasn't cleared, the fridge stops working, or your business partner suddenly pulls out. If that isn't all, sometimes the shock is bigger. You lose your job and the world comes to a standstill. It is then that you realize you were never taught to prepare for the worst.
Traditionally, there's a generation that grew up with jobs guaranteed. Like you'd literally go to work and the next time you're leaving, you're 65. That's not the case. Let's be honest, right? At the peak of COVID, we saw it. And also even some government parastatals like Kenya Railway and Telkom Kenya, when they laid off people, it was a shock. We never believed such a thing could happen. So all those things that can come up from nowhere, you have no control over them, but they have financial obligations.
Emergencies don't wait, but with the right preparation, they don't have to derail your life. Having a fund set aside gives you peace of mind by turning a crisis into a mere inconvenience.
When you look at personal finance and the wealth pyramid, it's always important to understand that emergency fund is the foundation, both from protecting you from the unfortunate situations that might come up, but also giving you the abundance mindset to know that if anything happens, at least I can afford to pay rent for 2 or 3 months. Because of that, let me get into long-term investments like real estate and set it up. I always say this, you can start with 1 month worth of your expenses in a bank account, then the rest you can put in a money market account. Because in Kenya here, unit trust or money market accounts, you can get your money if you need it within 2 to 4 working days. 1 month worth of your salary can be in a bank account, then the rest put in a money market account where it will also be earning interest for you as it grows over time. And start with 3 to 6 months worth of your monthly expenses.
Beyond survival, it matters to have emergency funds as they are not just financial cushions. They are growth tools that enhance stability.
And always encourage people to do what I call aging your money. So aging your money is to make your money old. So like, can you afford to pay this month's rent with the money that you are paid in March if you are salaried? That helps you to know that over time, extend the emergency fund beyond 6 months to 10 months, 12 months. There's no harm since it is still earning some interest for you. It's very, very important that we look at the realities of life. Then now we change even the way we are doing things.
The next emergency isn't a question of if, but when. That's why it's important to have an emergency fund you can rely on without stressing about how you'll survive. Now, let's take a quick break. From science to sweets, we travel through a microbiologist's journey to stunning cake designs.
Earn it, spend it, save, invest. Moolah, kila siku waste that